Fran, how should advisors and investors think about their portfolios heading into what is right now the fourth year of an exceptionally long bull market?
Yeah, that's right. 4 years of pretty much unprecedented equity returns over fixed income. In fact, 6 of the last 7 years, equities have returned more than 17%. And so what will happen is the portfolio will gravitate more to equities. And so the right course would be to rebalance out of equities into fixed income.
But are people doing that, or are people pressing their luck?
The good news is in past trends, I've been studying behavior and cash flows for 30 years at Vanguard. And normally you would see momentum, meaning whatever was doing well, investors would pile in. Over the last 10 years, we've actually seen very disciplined behavior. The equities, even we talked about this big bull market, equities have remained around 62% of the portfolio, which means advisors are rebalancing the portfolio.
So if they are rebalancing, are they heading into bonds? I know gold is getting a bid, but are bonds a good buy here in your opinion?
Yeah, so most of the cash flow, you hear about the exotics like crypto and things like that, but the vast majority of cash flows in the last 3 years have gone into fixed income and money markets, which is good because as you mentioned, the yields have come up over the last 2 to 3 years.
Can you drill down a little bit more about what allocators have been buying and selling in this market? Because from what I see, it's still a whole lot of Mag 7 in people's portfolios.
Well, the Mag 7 has been growing because the returns have been so good, but the cash flow actually into large cap growth and technology stocks in general has been pretty pedestrian. Most of the flows, again, have been into fixed income, high quality fixed income, and money markets, which is really good, keeping that portfolio rebalanced.
And when it comes to the fixed income part of their portfolio, do you recommend active or passive managers?
So the difference between active and passive, at least for us, is people get really into the debate of the two. We really think about it as, is it high cost or low cost? Because there really isn't a case for high cost index funds. A lot of people say case for indexing. There's not a case for high cost index funds, and there's not an anti-case for low cost active funds. So we believe in both. We have active funds that have done very, very well, but those are low cost and very talented managers managing those assets.
And what about the case for private market assets? How does that go down over at Vanguard? Because last year, people were really chasing lots of new products in private equity.
Yeah, so private assets is hard because it so much lays under that tent. So private equity, which Vanguard has and we believe in, is something that is different than regular equity. If you look at things like private credit look similar to high yield, but also different. So the question I would ask most people is, do they have found talent? Is it at a reasonable cost? And then can they have the illiquidity that comes with private investments?
Okay, and then finally, we're at the start of 2026. Are there any other trends that you foresee unfolding this year in the advisor space?
Yeah, in the advisor space, we've been on this journey of 10 years, which is almost outsourcing the investments, either through ETF model portfolios. Really think about the value proposition of wealth management and advice is not the investments. The investments can be outsourced. Really, the value proposition is behavioral coaching, tax mitigation, financial planning, wealth planning, and estate planning. We're seeing the industry move to those competencies and away from investment management competencies.
All right. Well, thanks for coming on and talking about it.
Appreciate it. Thanks for having us.